This week, the market gave us something rare, a major Supreme Court ruling, a sharp flush in silver, and then a violent reversal that told us everything we need to know. Because when a market absorbs bad news and rips higher anyway, that's not weakness, that's strength. Let's break down exactly what happened. The event, Supreme Court shock. The Supreme Court struck down the administration emergency tariffs as illegal. This was a real macro headline, not a range. One candle. The 3 a.m. New York time low. That was the line. And what happened? At 10 a.m. New York time, price came down and bounced exactly off that level to the dollar. That's not luck. That's structure. Markets leave footprints. When you understand the structure, you don't need wide guesses. You need precision. And this bounce confirmed that the underlying architecture is intact. COMEX inventory. The real story. Now let's shift from charts to vaults. Registered silver on COMEX, the metal actually available for delivery, now stands at 88.19 million ounces. In the last 30 days alone, a 51.9 million ounce drain. That's a 12.4% reduction in 1 month. Let that sink in. 12% gone in 30 days. And just in the most recent session, another 1.4 million ounces were pulled simultaneously across multiple custodians. That's not theory. That's reported data. Now here's the critical metric. The coverage ratio. Registered silver versus open interest is sitting around 0.4. That means for every contract that could stand for delivery, there's only 0.14 ounces of actual registered metal available in the vault system to satisfy it. 14% coverage. That's tight, extremely tight, and it's getting tighter. The deficit just went vertical. Now layer this with institutional projections. UBS is forecasting a 300 million ounce silver deficit for 2026. 300 million ounces. Annual global mine production is roughly 800 million ounces. That means the projected deficit equals about 40% of total annual supply. And this would mark the 6th consecutive year of structural deficit. But here's what matters. The imbalance is accelerating. The projected 2026 deficit is roughly 2.5 times larger than the estimated shortfall for 2025. This isn't steady, it's compounding. And above-ground stocks have already been drawn down for years. There is no deep buffer left to absorb another 300 million ounce gap. What the market just told you. So let's connect this. A negative macro ruling hits the tape. Silver flushes. Buyers immediately absorb it. Gold prints a historic weekly close. Vault inventories are draining at double-digit monthly rates. And a major global bank is forecasting a deficit equal to nearly half of annual mine supply. This is not a breakdown. This is pressure building. In part 2, we're going to cover the macro implications of the Supreme Court ruling, the $150 billion tariff refund risk, why policy uncertainty is not disappearing, it's shifting, the honest bear case risks you need to respect, and why all of this points to a single conclusion. Physical demand is outrunning supply, and the market just proved it. Because when bad news can't push price lower, the next move usually isn't down. So we saw the flush. We saw the reversal. They matter. But structure is structure. Here's what didn't happen. The Supreme Court ruling did not break support. It did not trigger panic continuation. It did not push price into freefall. Instead, it flushed weak hands and was immediately absorbed. That tells you there are buyers waiting for weakness, waiting for liquidity, waiting for headlines to create opportunity. The bigger picture. Physical inventory is shrinking. Institutional forecasts are expanding. Gold just marked a historic weekly milestone, and policy uncertainty remains embedded in the macro backdrop. This is not a clean, easy bull market. It's volatile, headline-driven, liquidity-sensitive. But underneath it all, the structural demand is persistent. And structural demand doesn't disappear because of one ruling. The final verdict. The Supreme Court ruling caused a flush. But the flush failed. Physical buyers absorbed it. COMEX inventories continue draining. Coverage ratios are critically low. A major global bank is forecasting a deficit equal to 40% of annual supply. And gold just closed at a historic level. Policy uncertainty has not been resolved. It has merely shifted form. Capital will continue seeking hard assets outside political disruption. Here's the important part. Don't take anyone's word for it. Verify the data yourself. Check the COMEX inventory reports. Read the UBS forecast. Look at the weekly gold chart. The evidence is public. And it's converging. When a market absorbs bad news and makes history in the same week, that's not exhaustion. That's pressure building. And pressure eventually resolves. The only question is how explosive the release will be.